Assalamualaikum, my name is Nurul Adila Akilah binti Zamri, along with my group members Nur Atira Izzati, Nurul Anisha, Wan Muhammad Alif, Nurul Fatihah, Nurul Nabila, Muhammad Fikri, and Muhammad Nufail Isham. We are from Group 3 will be presenting on Chapter 25 about other assurance services. So, for the first learning objective, I will be explaining and make sure that you all understand the level of assurance and evidence requirement for review and compilation services. For review and compilation services, the standard that we use is called International Standards on Related Services, or ISRS 4410. So what does this standard do? It is to apply the accounting and financial reporting expertise, which is the accountant or CPA firms, to assist the management in preparation and presentation of financial information in accordance with an applicable financial reporting framework based on the information provided by management, and we need to report in accordance with the requirement of ISRS. Accountants or CPA firms are qualified to provide a range of services related to financial statements. So the most common engagement that are provided by CPA firms for private companies are the compilation and review services. However, neither of these services is as extensive as an audit. This is because an audit requires the accountant to obtain an understanding of internal control, assess fraud risk, and obtain supporting evidence in order to support the figures shown in the included set of financial statement. While for compilation and reviews, it does not have such requirements. As in the picture shown, the amount of evidence needed for audit is extensive. This is because audit needs more evidence for audit historical financial statements in order for them to issue high level of assurance. For review, it provides limited assurance on their financial statements compared to a high level for audits. Therefore, less evidence is needed. On the other hand, no assurance given to the client for compilation service, and it also needs a minimal amount of evidence. Compilation services is also where the accountant prepare the financial statements on behalf of the client. The accountant needs to present to their client the financial statements that they have prepared. Therefore, they cannot express any assurance on the statements that they have prepared. To add, the types of client that usually request for compilation and review services is actually from private companies. An audit is probably the most common form of assurance that is used all around the world. However, in some cases, we need to know it might not be the right one for them, such as small and medium-sized companies are often not required by legislation to have an audit because of lacking the complexity of their larger counterparts, and the cost may outweigh the value added for this small operation. So review services are another form of assurance that can meet the needs of some small and medium-sized companies. Review services allow the accountant to express limited assurance that the financial statements are in accordance with the approved accounting standards. For these services, accountant will check and review the client financial statements. The scope is lesser than the audit of financial statement. As I mentioned earlier, the types of client that request for these services is usually comes from private companies such as small and medium-sized company. Public companies are prohibited from using these services. The reason is because public companies need to do an audit of financial statement, which then they need to submit to Securities Commission and need to follow MFRS, while private companies, they need to submit to Companies Commission of Malaysia and required to follow MPES. For the procedure suggested for reviews, in the first stage, it's almost the same as audit of financial statement. Firstly, we need to know your client in the first place. We need to know things like what industry they are operated in, for example, of industries such as banking, construction, or manufacturing. Then you need to know other important things like the company business transaction, which indicate what types of product that they produce, its ownership structure, key personnel, and the contents of financial statements. Then you need to make inquiries of management to financial statements and the staff that are in charge in that particular area. Some example of inquiries that can be included in is describing the accounting standard framework used to develop the financial or what unusual or significant transaction occur during the year. While in this stage, it is different from audit of financial statement, for review services, we need to only perform analytical procedures. That is the reason on why the level of assurance for review services is limited. It is different from audit of historical financial statement, where you need to perform test of control, test of detail balance, analytical procedure, and substantive test of transaction. The accountant need to design and perform analytical procedure based on their understanding of the industry and also the knowledge of the client in order to identify any relationship or an individual item that appear to be unusual. After they identify, the accountant then will further engage in inquiries of financial statement to the staff in that area to obtain explanation for the unusual relationship or individual items that they have found through the letter of presentation. Then the letter must be presented on the client letter in order for the letter to be valid. Then the accountant need to prepare documentation that is adequate in detail to provide clear understanding of the work that they have performed. It is called as review working paper, which consists of current file and permanent file. Permanent file are the file that is used to keep the information that used by auditors continuously, such as engagement letters and details of history of the client business, while current files are the files that save all information associated to the current year auditing, such as current year financial statements. Any types of services that you engage with the client, you need to prepare the documentation. Doesn't matter it is review, compilation, or audit services. For review report, the standard review report includes 4 paragraphs, and you also need to state the report title. In the report, firstly, you need an introductory paragraph that indicate what types of services given to the client, which in this example is review. It needs to indicate the company's name and when is the financial year end for the company. Then you need to indicate what are the statements that you have reviewed, such as profit or loss or cash flows. In the introductory paragraph, you need to indicate what procedure that you have performed, which includes a statement that a review primarily consists of analytical procedures and inquiries. It also needs to include statements that it substantially less in scope than audit, and we do not express such opinion as per audit of financial statement due to lesser in scope of review. In the second paragraph, it needs to highlight management who is responsible for the preparation of financial statement. For private company, they are allowed to engage with CPA firms for the preparation of their financial statement. However, the responsibility of the preparation of financial statement is the company responsibility, not only the preparation, but also maintaining internal control. The third paragraph, it will highlight the responsibilities of the accountant to conduct the review services in accordance with the Malaysian Financial Reporting Standard issued by the Malaysian Accounting Standard Boards. It also needs to indicate that those standards require the accountant to perform procedures to obtain limited assurance. If the accountant do not discover any material misstatement as per this example, they need to write that there are no material modification that should be made to the financial statements. And in the fourth paragraph, which is the accountant conclusion, the accountant needs to provide their opinion. In the example, it expressed limited assurance in the form of negative assurance that we are not aware of any material modification that should be made to the accompanying financial statement in order for them to be in conformity with applicable accounting standard. If in positive assurance, it should be like the one that we use in audit report. We believe that the client financial statement is prepared in accordance with the approved accounting standard. It shows true and fair view to a company's operation. And if a client has failed to follow applicable accounting standard in a review engagement, the report must be modified. For compilation services, it deals with the accountant responsibilities in assisting management with the preparation and presentation of historical financial information without obtaining any assurance on that information, and to report the engagement in accordance with ISRS. And as I said earlier, the reason for compilation has no assurance given to the client is because they are the one that prepare the financial statements on behalf of their client. So they cannot present any assurance on the financial statement that they have prepared earlier. Private companies such as small and medium-sized company may engage with CPA firms to prepare monthly, quarterly, or annual financial statements and to issue a compilation reports that may be provided to external users, such as banks, in order for the client to apply loan with the bank. The requirement for compilation services is quite the same as review services. Firstly, they need to have a form and understanding with the client in a written engagement letter. This includes the objective of compilation engagement, limitation of services to be provided, and a description of the report if there is a report that need to be issued. In the agreement, also need to mention that the management responsibilities for the preparation and fair presentation of financial statements and accountant does not provide any assurance toward the financial statements. Then the accountant need to have an adequate knowledge about the accounting principle and practices of the client industry, and at the same time, accountant need to have enough knowledge and full understanding about the client organization, such as nature of the client business transaction, the accounting principles and practices that they use, and content of their financial statements. Then, accountant need to make inquiries to determine whether the client information is satisfactory. This is done to check whether if there is any obvious omission or errors in calculation and in the application of accounting standards. If accountant have detected the omission or errors, they can request management to provide additional or corrected information. And if they fail to provide that additional information, the client information will change to unsatisfactory. Lastly, the accountant need to prepare documentation in sufficient detail to provide a clear understanding of the work that they have performed by them to the client. Now I will be explaining on the form of compilation report. So firstly, for compilation with full disclosure, it is the same as audit of financial statements and review. It should be a full disclosure on the financial statement. It needs to comply with the approved accounting standard, which is MFRS. This type of financial statement that require full disclosure, including cash flow, balance sheet, income statement, and others. If there is any pledge of asset or third-party transaction, it needs to be disclosed in the notes to the amount. Then, when compilation services with no disclosure has been elected, the accountant should clearly indicate that in the report, but the accountant would not expect it to include such disclosure in the report that they have prepared. Some statements need to be added after the conclusion paragraph of the standard compilation report. This type of compilation services is usually used for management purposes, since financial statements are designed to meet management needs in managing their business. Lastly, compilation without independence. It means about the independence of the auditor, or the auditor is not independent of their client. This form of compilation services is only applicable to private companies, since compilation services are for private companies. Public companies are prohibited from using this form of services. If public company not independent, for example, they have financial interest in the company, it will affect the audit report, and we need to issue a disclaimer audit report. However, if private company, they are allowed to do that. For example, the auditor have shares in the company, but the things that they need to do is they need to disclose in the compilation report that they are not independent. For the form of compilation report, it also offers the same as review. You need to have introductory paragraph which indicate types of service given, company's name, and date of financial year end for the company. In the example shown, it meets all the requirements needed, which are the compile service William Company and date of financial year end on 31 December 2011. Then you need to mention the statement that you have compiled, such as statements of income, retained earnings, and cash flows, for example. You need to also state that you have not audited or reviewed the financial statements. In the second paragraph, you need to indicate that it is the management that is responsible for the preparation of financial statement, including maintaining the internal control. While in the third paragraph, you have to state accounting responsibilities, which is to conduct compilation services in accordance with the approved accounting standard. And there is a statement that you need to indicate that The objective of compilation services is to assist the management in presenting their financial statement without undertaking or provide any assurance to the client. For compilation services without disclosure, the accountant need to inform the management has elected to do compilation services without disclosure. Then you need to indicate without disclosure on what statement. As in this case, it is the statement of cash flows. These companies are allowed to not prepare the cash flow statement since they are a private company. Then that's why there is no big issue on inadequate disclosure for this compilation service. And as I mentioned earlier, compilation without disclosure is intended for management purposes since it's only involved in the process of company in managing the business. That's all from me. I will pass the presentation to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Naatila Izzati Izam. I will continue for the learning objective 2, which is describe special engagement to review interim financial information for public companies. First, the review of interim financial information for public companies. The SEC will require quarterly financial statement to be reviewed by the company's external auditor prior to the company's filing of the Form 10Q with the SEC. Other than that, the SEC also will require a footnote in the annual audited financial statement by disclosing quarterly sales, gross profit, income, and earning per share for the past 2 years. So, the noted of the account in the annual statement will be labeled as unaudited, and the footnote information review procedure must be implemented by the CPA firm because the annual audit and the review of the public company interim engagement statement is performed by the same CPA firm, and it will be referred to the auditors and not accountant for the interim review. Next is for the review service. A public company interim review will be include the 5 requirements for review service engagement. So here is the 5 requirements for review service engagement. So the first one is will obtain knowledge of accounting principle for client industry. Second is obtain knowledge of the client. Third, make inquiries of management. Fourth is perform analytical procedure. And the last one is obtain a letter of representation. Moving to the next slide, which is a review for a public company does not provide a basis for expressing a positive form opinion level assurance. Usually, auditor will not perform testing of accounting record, independent verification or physical examination. Next is the review is conducted according to the International Standard on the Review Engagement ISRE 2410. So this is the example of a report for interim financial statement for a public company, which is the report of independent registered public accounting firm. So for the report, each page of the interim financial information with which accompanies the report should be clearly marked as unaudited. If the auditor determines the interim statement violates accounting standard, the report should be modified. So that's all from me. So I will pass to the next presenter. Thank you.
Hi, my name is Nurul Anisha and I will continue to present learning objective number 3. So learning objective number 3 is to distinguish AICPA attestation standard from auditing standard and know the type of engagement to which they apply. So this is the attestation standard. First, the AICPA has issued 11 attestation standards that parallel the 10 generally accepted auditing standard. Second, in general, auditing standard apply to attestation that deal with providing assurance on historical financial statement, including one or more parts of those statements. Third, to provide additional guidance for doing attestation engagement, the Auditing Standard Board of the AICPA issues Statement on Standard for Attestation Engagement (SSAE). The Auditing Standard Board decided not to attempt to define the potential boundaries of attestation engagement except in conceptual terms because new services are likely to arise. Next, there are three levels of service, which are first, examination, second, reviews, third, agreed upon procedures. So the first one is examination. It results in a positive conclusion. A report on an examination is unrestricted as to distribution by the client after it's issued. Client can distribute widely, including prospective investors and for sales and marketing purposes. Second, reviews results in negative assurance conclusion. A review report is also unrestricted in its distribution. Review engagement are prohibited for most services where specified attestation standards have been issued, such as prospective financial statement. And the third one is agreed upon procedures. All procedures the CPA will perform are agreed upon by the CPA. Such reports are limited in their distribution to only the involved parties who know the procedures the CPA will perform and the level of assurance resulting from them. So this is the conclusion of the type of engagement, amount of evidence, level of assurance, form of conclusion, and distribution. Okay, so these are the types of engagement, which are the first one is web trust and trust services. Second, reports on controls of service organization. Third, prospective financial statement. And the last one is agreed upon procedures. That's all from me, and I will pass to the next presenter. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Wan Muhammad Alif bin Wan Hassan Alimi. I will be presenting about the learning objective 4, that is understanding the nature of web trust and seed trust assurance service. As we know that confident focus standard that American Institute of Certificate Public Accountants, AICPA, and Canadian Institute of Chartered Accountants, CICA, have established serve to create and foster consumer confidence, have become known as the trust service principle. With this firm guideline in place, it makes it easier for in-house auditor and outside consultant to objectively evaluate various controls that give them the best and the most comprehensive understanding of the organization at the hand to control. With a focus on e-consumers and other online consumer-centered interaction, trust service principle offer transparent to consumer by providing a set of a best practice to protect them against security leaks, loss of sale, and damaged data. Web trust and seed trust are the most common report based on the trust principle used to provide report to internet-based consumer. Next. What is a web trust service? In a web trust ascertained engagement, a client engaged a chartered professional accountant (CPA) to provide a reasonable assurance that a company website comply with a certain trust service principle and criteria for one or more aspects of the e-consumer activities. The web trust service is specific service developed under the broader trust service principle and criteria jointly issued by the AICPA and CICA. The CPA firm assess whether the company website comply with the 5 trust service principle. As we know that web trust one of the report available based on the trust service principle to instill and maintain strong consumer confidence when conducting e-consume transaction. Web trust use several criteria to help evaluate the overall characteristic of the company online transaction environment. IT leaders and outside auditor rely on these following criteria when performing evaluation. That is, these 5 trust service principle. the entity disclose and maintain comply with it. Firstly is security. Security practice ensure that the system is protected against authorized access, meaning that your system is safe from all form of unauthorized access, whether internal or external. Continually monitor the latest and most effective safety measure that you and your team can take to ensure optimal protection for your customer peace of mind as well as yours. Second is availability. Availability practice ensure that the system is available for operation and use as committed or agreed. Whether it is important to regularly review the service level outlined in your agreement with each of your online customer. Not only does this keep you in a good standing with your customer, but it's also attractive to your application service provider, ASP. Third is processing integrity. Processing integrity ensure that the system processing is complete, accurate, timely, and authorized. Knowing that each transaction will go through successfully and safely is another attractive and confident building quality that the customer appreciate and remember. Next is 4. The fourth one is online privacy. Online privacy practice ensure that the personal information obtained as a result of e-consumer is collected and used, disclosed, and retained as committed or agreed, which means the collect personal data is an organic part of e-consumer and other online transaction. However, it takes a leap of faith for many customers to trust the process in the first place. But when they see the news reports of hacking and stolen data, it's critical that you ensure them that you do everything possible to protect your confidential information that they disclose to carry out transaction per your mutual agreement. And lastly is confidentiality. Confidentiality practice ensure that the information designed as confidential is protected as committed or agreed. Means that always cornerstone of consumer trust building. Your work to protect business to business information is essential to the process. When your customer know that you have safeguard in place to protect their personal data from any type of intrusion, they are more likely to return for additional business transaction. Next is C-Trust service. In C-Trust engagement, the C-Trust lesson CPA evaluate a company's computer system in trust service principle and criteria. The service provide assurance to management, director, or third party about their reliability of information system used to generate real-time information. Meaning that they trimming the trust service principle down to 3 vital criteria. The C-Trust engagement is designed to increase the comfort of management, customer, and business partner in system that support a business or particular activity. A C-Trust engagement brings focus to following 3 pieces of information to help build consumer trust. Firstly is integrity, providing the best and the most consistent system processing, making sure each transaction is complete, accurate, timely, and authorized. Secondly is security. Keep your system safe by following the most current security trend to guard against any potential threat to your business system against various threats. And third is availability. Monitor your agreement with your customer and always ensure that your system is always at the agreed service level. Okay, once complete a series of tests for the evaluation, the auditor or assessment professional give an opinion on the maintenance and effective of the service organization control with the use of the C-Trust assurance service. That's all from me. I will leave to another presenter.
Assalamualaikum warahmatullahi wabarakatuh. Thank you for our presenter just for the presentation just now. My name is Nurul Fatah binti Muhammad Rusti and I'm going to continue with learning objective number 5. Okay, so in learning objective number 5, we have to understand the engagement to report on internet control at a service organization. Okay, so next. Okay, report on control at service organization is to help the companies to establish the trust and confidence in their service delivery process and control. Okay, this engagement have historically have been referred to as AC30 engagement because the guidance for the service auditor was contained in the auditing standard. The auditing standard board recently moved the guidance for service auditor who are engaged by a service organization to issue one of two type of report. So this is the type of report. Okay, so number 1 is report on description of a service organization system and the suitability of the design of control, which is type 1 report. Okay, in type 1 report, the service auditor expressed an opinion about the fairness of the description of the service organization system and opinion about the suitability of the design of control in that system. The service auditor obtained and read the system description prepared by the organization management and assess whether the description is prepared by the organization and fairly presented. In making the assessment, the service auditor evaluates suitable criteria in preparing and presenting the service organization system. For example, the service auditor would evaluate whether the organization description include information about the procedure by which transactions are initiated, authorized, recorded, processed, and reported for user entities and the related accounting record prepared to support this process. In type 1 engagement, the service auditor also performed procedure to obtain sufficient available evidence to obtain reasonable assurance about the sustainability of the design of control. In making that determination, the service auditor evaluates whether control have been designed to address risk threatening the achievement of control objective and whether those control, if operating as described, provide reasonable assurance that those risks will not prevent achievement of control objective. Okay, so in type 2, in type 2 engagement, the service auditor perform tests of the operating effectiveness of the control at the service organization. In addition, to produce performed in the type 1 engagement, when testing control at the service organization, the service auditor perform tests of control using procedures similar to those described in early chapters. In obtaining sufficient appropriate evidence about the operating effectiveness of those controls throughout the period under audit. The service auditor type 2 report contains two opinions about the description and suitability of the design of the control that are provided in type 1 report, plus an additional opinion about the operating effectiveness of control throughout the period. Okay, so that's all from me. I will pass it to the next presenter. Thank you.
Hi, Assalamualaikum. My name is Nur Nabila binti Muhammad Fauzi. So today I'm going to present about Learning Objective 6, which is understand special engagement to attest to prospective financial statements. So first, what is prospective financial statement? So prospective financial statement refer to the predicted or expected financial statement at some future date, at some future periods, and at some future dates. So prospective financial statement had two types of prospective financial statement, which is the first is forecast and second is projections. So forecasts are the prospective financial statement that present an entity expected financial positions, result of operations, and cash flow to the best of the responsible party knowledge and belief, which is banks are the one that commonly require these informations as the part of the loan applications. And projections are the prospective financial statement that present an entity financial position, result of operation, and cash flow to the best of responsible parties' knowledge and belief, which is given one or more hypothetical assumptions. For example, projected financial statement might assume the company is able to increase the price of its primary product for 10% with no reductions in a unit sold. So next we go to the use of prospective financial statement. So prospective financial statements are prepared for one or more audiences. So the two types of use is general use and also limited use. So general use statements are prepared for use by the third party, such as the inclusions of financial forecasts in prospectus for the sales of hospital bonds, and also limited use statements are prepared solely for the third party with whom the responsible party is dealing directly, such as the inclusions of financial projections in a bank loan application document. So forecasts can be provided for both general and limited use, while the projections are more restricted to the latter because limited users are in the best position to understand the prospectus statement and related assumptions than other parties. For example, a potential venture capital investor can ask the responsible party about hypothetical assumptions in a projections, where a removed user, such as a reader of a company prospectus, cannot. Okay, so next we go to the types of engagements in prospective financial statement. So AICPA attestation standards prohibit a CPA from performing a review of a forecast or projections, because a review service implies the CPA can be moderately satisfied about both the computational accuracy of the projections and the assumptions on which the projection is based. So to avoid this confusion among the user, the AICPA create more specific attestation standard prescribing the following types of engagement for prospective financial statements. Is first, an assumptions engagement in which the CPA obtains satisfactions as to the employees to the completeness and reasonableness of the assumptions. Next, a compilations engagement in which the CPA is primarily involved with the computational accuracy of the statements and not the reasonableness of the assumptions. And third is an agreed upon procedures engagement in which the CPA and all the user of the statements agree on specific limited attestation procedures. So next we go to the examinations of prospective financial statement. So AICPA attestation standard clearly stated that CPA are not attesting to the accuracy of prospective financial statement. Instead, what they do are they examine the underlying assumptions and the preparations and presentations of the forecast or projections. So there are four elements in the examinations. First is evaluating the preparations of the prospective financial statement. Next is evaluating the support underlying the assumptions. Third, evaluating the presentations of the prospective financial statement for conformity with AICPA presentations guidelines. And also fourth is issuing an examinations report. So these elements are based on the accumulating evidence about the completeness and reasonableness of the underlying assumptions as disclosed in a prospective financial statement. So to make the evaluation, the CPA need to become more familiar with the client business industry, identify the significant matters on which the client future results are expected to depend, and also they need to determine the appropriate assumptions have been included with respect to this key factor. Okay, so that's all from me. I will pass to the next presenter.
Bismillahirrahmanirrahim. My name is Muhammad Fikri bin Hamdan, and I'll explain about Learning Objective 7, which is agreed upon procedures. So, an agreed upon procedures is a standard a company or client outlines when it hires an external party to perform an audit on a specific test or business process. The procedures, which are called audit standards, are designed and agreed upon by the entity conducting the audit, as well as any appropriate third parties. The auditor's report on the findings is usually restricted to those parties who develop the agreed upon procedures because of the specificity of the desired result. For example, agreed upon procedures may be developed by one entity that is considering purchasing another business. The purchasing entity will likely develop the agreed upon procedures to help determine specific monetary or other information about the business it may acquire. In an audit conducted under agreed upon procedures, the auditor provides only factual findings and does not offer opinions, conclusions, or assurance in the final report. Instead, the auditor's report simply presents the facts with the audit facilitators drawing their own conclusions from the findings. So next, we'll move on to the objective of an agreed upon procedure. Okay, the objective of an agreed upon procedure engagement is for the auditor to carry out procedures of an audit nature to which the auditor and the entity and any appropriate third parties have agreed, and to report on the factual findings. As the auditor simply provides a report of the factual findings of agreed upon procedures, no assurance is expressed. Instead, users of the report assess for themselves the procedures and the findings reported by the auditor and draw their own conclusions from the auditor's work. The report is restricted to those parties that have agreed to the procedures to perform, since others, unaware of the reasons of the procedures, may misinterpret the result. So when performing an agreed upon procedures engagement on historical financial information, practitioners should, as a minimum, comply with ISRS 4400 engagement to perform agreed upon procedures regarding financial information. ISRS 4400 also provides useful guidance for engagements regarding non-financial information. So ISRS 4400 requires compliance with the applicable requirements of the Code of Ethics for Professional Accountants issued by the IESBA. The ethical principles that apply to agreed upon procedures engagements are the professional responsibility for integrity, objectivity, professional competence and due care, confidentiality, professional behavior, and technical standards. Independence is, however, not a requirement for agreed upon procedures engagement. The specific terms of an engagement may, however, require the practitioner to refer the independence requirements of IESBA's Code of Ethics for Professional Accountants. Equally, ISQC1 will apply to all services that the practitioner provides under ISRS 4400. Therefore, being able to assert compliance with the standard is a quality mark for a chartered accountant. As a result of a client's request or the need to comply with legal and regulatory requirements, a practitioner may perform an agreed upon procedures engagement in accordance with specific requirements or standards other than ISRS 4400. where the practitioner is unable to follow ISRS 4400 in full. For example, because of a specific regulatory or other requirement, he should not refer to the engagement as having been conducted in compliance with this standard. For many engagement, irrespective of whether the practitioner performed the agreed upon procedure engagement in accordance with the legal and regulatory requirements, the practitioner should make as much use of ISRS 4400 as possible. I'll go to AUP I go to the example of audit upon procedures for the preparers use only. So for an entity which has no external requirement for an audit or formal assurance opinion in accordance with assurance standards, agreed open procedures of a specific risk in financial or non-financial information can be a cost-effective way of obtaining comfort for the preparer. This can be supplemented with professional views, though not with a formal assurance opinion if the scope of work is AUPs. So this is the example of AUPs for the preparers use only, which is subject matter for is stock and fixed asset. So this is the third example, which is for the payroll. So next, I will go to the audit open procedures for the use of a third party. So this is the example. So agreed upon procedures can also provide comfort to a third party of an entity's compliance with regulatory or contractual requirements. Practitioners will need to consider the increased risk associated with the third party's interest in the report. So for the example, they prefer to agree a scope of work which fits clearly within ISRS 4400 rather than agreeing to provide subjective professional views. The practitioner should also consider what terms and conditions should be attached to the third party's user of the report. So that's all from me. Thank you.
My name is Muhammad Falisham and I will describe about the learning objective 8 that is described other audit and limited assurance engagements related to historical financial statements. So the first one is the other comprehensive basis of accounting. There is four for this. The first one is cash or modified cash basis. With cash basis accounting, only cash receipts and disbursement are recorded. Under modified cash basis, the cash basis is followed except for certain items such as fixed assets and depreciations. The second one is regulatory agency basis. Basic used to comply with the requirement of regulatory agency basis. For examples, it is including the uniform system of the requirement of railroads, utilities, and some insurance companies. The third one is the tax basis. The same measurement used for filing tax returns are often used for financial statements preparation. Usually, the small business. The last one is definite set of criteria. This method having substantial support. Example for this is the price level basis of accounting, that the method of account must be applied to all material items in the financial statements. Okay, the next one is specified elements, accounts, or items. The auditors are often asked to audit and issue reports on specific aspects of financial statements. there are two differences in this type of audit. The first one is materiality is defined by item audited. This is to require more evidence than the item being verified. It is just one of many parts of the statements. For example, if the sales accounts is being reported separately, a smaller misstatements will be considered that it is when sales are one of many accounts in a full financial statement. Okay, the second one is GAAP does not apply. This is the first standard of reporting under GAAP. It does not apply because the presentation of elements, accounts, or items is not a financial statement prepared in accordance with the applicable accounting standards. Okay, and the last one is the debt compliance letters and similar report. The return may issue reports on debts and compliance and similar engagement. A separate report or by edit a paragraph after the opinion paragraph as part of the report that express their opinion on the financial statements. In other case, the auditor must observe the following method in such engagement, which is engagements and reports should be limited to compliance method. The auditor is qualified to evaluate. The next one is the auditor should provide a debt compliance letter only for a client for whom the auditor has done an audit of the overall financial statement. And lastly, the auditor's opinion is in the form of negative assurance, stating that nothing came to the auditor's attention that would lead the auditor to believe there was non-compliance. So that's all from us. Thank you.